We are looking at the options for the week. We have simulated positions. We're going to execute automated trading. On Monday of next week, we're going to automate our trading. This week we have manual trades that we're going to review right now. You can see we are testing the orders here. This is a coding error. We have a coding error. Transmitted order not accepted. Probably because the market's closed. But we're testing. Now let's look at completed. We should have some. Okay, I guess they started over for the day. But nonetheless, we have positions. Easy to see. They're current. I was going to show you how we got them. We had a bunch of spreads. Bear calls. Bear calls. Bull puts. Right? Some of these were prematurely exited due to pin risk. But we started the day with 8,000. Our net liquidation is at 8.2K. So we're up 200 from that standpoint. But what did we do? I wish I could show you the trade history, but apparently it's not wanting to. The history's gone because it's a new session. It's after 6 p.m. I guess. So basically, what occurred was we did these bear calls, bull puts, and we did a ton of them. You can see them all here. 80, 80 half, 57, 85, 57, 80 calls. We would sell one and buy one, for example. Okay, so that's what happened. So some of these losers show large losses, like 15,000, but that was offset by presumably the 57 0 put. Where is that? 57. There's the 5705. So where's the 57 even? I'm sure. Yeah, there it is. 14,000. So that 1457 and the 5705 put. That's kind of curious that we lost on this because we basically were short put spreads. So I'm not sure how we had the loser there, but an example of a winner, the 5730 put, we made 34 grand, 863. The other one we lost 34,000, right? So that leaves us $800 of profit from that trade, and that was a spread, 5735, 5730. So we sold the 5730 put, we bought the 5735 for less, and that just offsets the risk and lets you get these positions. So this is pretty much what's going on. Now you'd be like, okay, well, what was the entry? Okay, and what was the sale price? And you can do the spread and just assume if you make $800 on the trade, certainly the price that you sold it was a better price than where it ended the day and expired worthless. Presumably that was one of those that expired worthless because the market closed at 57.76 or something close to that. So that's why this expired worthless and that came in as a profit. This other one, I guess it got closed as, so I'm not sure why, but it should have been a winner as well. But I can't see the trade history. But overall, the net liquidation is appropriate. We took some of the proceeds and we did a combo with buying a call. Look at the dates. You can see these dates are further, 26th, 17th, March 14th, 21st. We are long these 12 20s. That's good because if the market starts to rally heavy on the open Monday, we're going to be very good exposure. And, if it doesn't, 200 of these premiums is pretty much profit anyways. So when you think about it that way, we pretty much have a cost-free trade. I mean, there's still a little risk is the point. We have $200 of profit and it could go away if we hold these to worthlessness, which we don't intend. But we also plan on trading around them. So we have a lot of long exposure now. So we can obviously be a little more aggressive on selling any calls if we want to generate some protection there to offset that. And that's something to consider for next week. And that's why I'm not upset at all to go into the weekend with a somewhat core position, uh, knowing that we can easily sell against it and be able to, you know, protect ourselves from downside, and in that case, sell more calls. Just keep selling the calls that a shorter date. That's the main thing. These have longer dates. That's the key. That's what I want to really stress here. Is the key is the time, and I know I learned it particularly hard, but it's good. It's a good thing to know. So I'm sharing it with you. That is the key. The time. You may be wondering, what is the time? Well, the time is the expiration date, March 12th, 20th, 12th, 21st, 14th, 17th, 26th. These dates, look at the calls, the 6450 and the expiration. The reason you're noticing the dates are longer, the price has to be higher to get that low price, because look at the average prices we got on a lot of these. 23, 33, 68, 38, 78. Market value is 143. These are futures, so these are still very volatile assets. They might sound insignificant, but they come up to a value, especially if you think, I could liquidate and have $200 profit in the account, and it's opportunity cost to an extent. So, but we have to have an ongoing position in sentiment towards the market, and that is generally, it tends to be optimistic, and it tends to be something that goes higher. Over a long period of time, I think anybody could say that, yes, there's times where it goes down, but as long as the market keeps opening, there's probably going to be accumulation just because it's an asset. Now, let's say that the market drops. We're obviously selling calls. That's what our algorithm that we're programming and testing over here. These are all test orders. Like, watch, I'll activate the algorithm, and you're going to see what's going to be basically to come. Now, keep in mind something. The price is not known because the market is closed. So these are going to be orders that you don't really so much see coming through correctly in terms of the actual price, because it's the market is not open right now. So these prices for the bids are empty. So it's going to think, hey, of course the price is lower, so it's going to do something funky. But you can see the order come through right now at the very top. Okay, see, that just came in. Okay, but let's it's going to come in again every 12 seconds. Okay, so you can see this is what's happening from a standpoint. Now, let's add some code to this just to demonstrate what is to come. No, I don't want to do it right now. I want to add a call. But I have to get another quote. But first of all, I need to resolve some things related to time lookup, because the strikes are not updating for the algorithm. So this needs to be addressed before I add another leg. But then after I have another leg, then I'll add the purchase of the call. So what you're seeing on the actual positions is kind of simulating what's going to be coming, kind of testing the theory, if you will, in manual mode. And what are some things that I learned today? Number one, focus on time. Time is more important than almost the premium. Time. If we can get something to it in July, then we have a long-term free risk-free position that's basically enjoyable until July, and the market even just gets a couple bit of days of pushing higher. Then we're looking at something real nice, and that's kind of the position we want to be in. And even if the market tanks, it could happen, we'll just be buying calls closer down. I mean, sure, and then the market consolidates and doesn't do anything. Well, that's why we're selling premiums as well at a shorter date, closer in, so we can get a little bit of premium. And we're not even necessarily, hopefully, ideally going into our cash, and we just continue to have a higher cash balance, and we can continue to buy these calls regardless of the strikes. Even if the market tanks, we just buy lower strikes, and we get further dated time, and we move out the proposition. So that's kind of the logic here behind this concept. I think it's a sound logic, especially from a time standpoint. I think the time standpoint is critical. I think the further we can get on the time, the better, especially because they're more sensitive in it, and they retain value a little better. It's wonderful. It's absolutely wonderful. So It's almost better to have something a little further out than it is to have something close. I mean, it sounds weird, but if you're looking for an earnings play, I almost think it's better to go further out on the date than it is to go on the. Yeah, this thing's getting overwhelmed. I gotta stop it. I can't be sending crazy amount of orders on the weekend. So let me stop this. But I'm basically okay. So I turned off the order flow. Okay, so we're basically getting ready to automate this trading. We're not going to be doing anything near that rate, not 12 seconds. It's going to be like probably maybe once an hour. So we'll be selling if price is below moving average, we're going to be selling calls. If price is above moving average, we're going to be selling puts. In the ideal situation, we are also buying a deep out of the money, long expiration call. That is the goal. We want to do that. I think that's a good strategy, and especially if we can get long dated. So I mean, we're moving towards this. I've been working on developing programs for trading a long time, and this is probably the best concept I've had yet. I think selling premiums to generate other trading activities just seems to be the way to go. So I prefer if I had, if the situation were different where we had tons of cash, we could just do covered calls maybe. But even then, the returns probably wouldn't match in terms of percentage, hopefully, what we're about to do here. That's just hypothetical, but we're obviously documenting this because we believe the time is important. And if we are able to just be patient enough to ride this wave out, and we do have a couple of days of some popping, then we ultimately have kind of a risk-free exposure to a massive rally. Because it brings us to our next point. We basically have purchased these today, these options, with premiums of successful put sales. So we went through one of them earlier where there was approximately $800. So some of the proceeds offset the losses of the calls that we sold, and some of the proceeds contributed, of course, to buying these options that were still long. And we could liquidate them and even out, and maybe there's some slippage and we don't necessarily have $200 profit. But that brings us to our next point, is the potential. And why do we even trade as potential? And this is the plot of the current asset class of our portfolio. You can see cash and then the futures options. We have basically $353 of option premium. But this is the upside potential that we have. And we know the dates, of course, from the positions. We can see those down here, approximately the 12th through the 20th. So we can simulate on this the 20th, the 12th. And the entire portfolio, let's just say best case scenario, we come in here on that's Wednesday. That's the expiration date. Let's say we come here on Monday at the open on the 10th, and we just see what we're at from the portfolio perspective. If we can get a 1% move, which would be around 500 points, we'd be looking at around a gain of, let's just calculate, 58 point day, okay? And we're at 57.77, I believe. The S&Ps are trading at, it's highly speculative, but we're going to sell premium anyways Monday. Technically Sunday. The S&Ps closed the day at a price of 57.76. So 57.76. We come in here Monday. I think this is a little wrong, but if we get up to around, just a 100-point move, we could be looking around $5,000 in profit. I would imagine. If we can get to 58.50, for example, this thing allegedly says we'll have like 7 to 8K. I don't necessarily think this is right. I think it's off by probably at least $1,000, because right now it's saying we've got an $800 profit, which we don't. We're not in profit at all. So I'm just taking 800 away from this thing. But this gives you the idea, as the market, the index, our exposure to these calls, this is pretty much where we're going. In theory, if the S&P closes, Monday at 7,000, which is not likely. We'd be sitting on a $2 million gain, more or less. That's kind of what this tells you. This is the price down here, and we have the P&L on the right side. So you can see, unlikely. You're not getting to 7,000 on Monday. It'd be crazy. It could happen, but it's like not happening. Right? So you can see the movement, plus 20, right here, plus 20. Be a $1.4 million gain, right? If the S&P goes up 20% on Monday. Now, if they can make it 20% by March 12th, then we're looking at 1.4, a little less. But, this is unlikely. But again, the time, everybody knows how options work. There it is. Current price is minus 276. So that's what it's saying. And it's got the ES index. Current is 57.39. So this is the ES index. We need actually a different instrument here. S&P index. We can actually type this in here. Futures. Yes. Okay. Where did it go? Let's just compare it to SPY. SPY. It doesn't even, I'm not sure why it's not working. But anyways, this is the point of our P&L and potential. So time, let's see what happens. We're going to be selling stuff. I got to get back to automated programming. So we'll talk to you guys later.